Well, welcome to Horde's Dairyman Livestream. I'm your host, Corey Geiger, Managing Editor of Horde's Dairyman. We have an exciting episode planned for today, the Dairy Farm Finance Pivot. Today's episode of Dairy Livestream is sponsored by generous support of Diamond V, and they've sponsored a previous program as well. We're going to start, as viewers know, we always start with some positive news here. And one of the positive things, we're going to start with a poll question. We're going to turn it right over to Jim here. And the poll question is going to be like this. Since April 22nd CME trading, Class 3 futures for May to December 2020 contracts improved by this average. So that, go ahead, no improvement, $1.04, $1.66, or $2.34. Why is April 22nd important? That was a Dairy Livestream broadcast just 4 weeks ago. So we're getting some great response on our poll question here, and we'll leave that go for just a little bit. And obviously you have to be watching the video part to get the poll question. I know we have some viewers that are got their earbuds in and listening to audio. We welcome that, but the only way to participate in a poll question is when you're on your computer. So let's go ahead, Jim, when you're comfortable, and close the polls. And so we see that there's some range in the answers here, but our audience members know there's been an improvement. And April 22nd, this May to December Class 3 futures averaged 1371. And yesterday, they climbed all the way up to a 1605 average. That's a $2.34 per hundredweight improvement. That's significant. It's not as good as it was in the beginning of the year, but it's a big, big rebound. And Chris, what do you think's going on in the market?
Well, thanks, Corey. Happy to be here. Yeah, you know, it's been pretty remarkable the last 4 weeks what's happened, and really in the last week to 10 days has been a lot of it. The recovery that the market's been seeing, and I want to specify here, we're talking about federally regulated minimums, right? So there still is some issues going on with basis and some co-op reblends and stuff. So it doesn't necessarily mean that ends up back in the farmer's pocket here. But, you know, I think the market right now is searching for an equilibrium. It's trying to take into account the news that we've got on both the supply and the demand. And when we talk about milk supply and demand, we're talking about really inelastic, both supply and demand. As an economist, we talk about it that way, which means we've got really steep curves for both supply and demand, which means small changes in quantity can lead to large changes in prices. So for demand, you know, we're looking at states reopening. We're trying to assess when people might start eating out, and restaurants and food service and refilling that supply. And, you know, what's going to happen there if we suddenly see an increase there and we're going into nice weather, people want to be outside, they want to be out doing things. So there's some reasons to have optimism on the demand side. And on the supply side, the co-ops and processors have instituted some programs in some places to kind of balance out the issues that they had, trying to adjust from food service to eating at home. And so, you know, there's some supply cutbacks in some places regionally. So the market is looking at the potential for there to be a little bit of a cutback in supply in some places, an increase in demand, and it's being optimistic. And I hope it's right. I really do. But I would stress actually that there's a lot of uncertainty in the market right now. And, you know, I think it's really optimistic when you're looking at, you know, well, this morning it was 1773 at one point for Class 3 June price, which I hope is realized. But I think if you're a dairy farm manager today, you've got to take a look at some of those prices that are out there. And, you know, back when it was, you know, $13, $12, $13, you probably weren't thinking a whole lot about risk management opportunities because, you know, I had to understand locking in a bottom and paying for it. You know, that's kind of hard to swallow. But I think if you're looking at your cost of production and you're thinking that maybe there's some opportunities in the third and fourth quarter and into next year, this might be a time to have a conversation with, you know, with the accountants, figure out what your cost of production is, and then look at the tools that are out there. And then I guess I'll finish up here by saying, you know, the cash flow issues that some of these farms are experiencing because of this big cutback milk price that they've been receiving because of the market adjustments, because of the reblends, because of all these issues that the co-ops and processors have had to deal with. Farmers are clearly watching cash flow, and so that's a reason to consider risk management if it works for you. But also, it's a reason it won't be immediate, but the dairy margin coverage program, if you signed up, might provide some relief for some farmers on the cash flow side. Dairy revenue protection, and then now we've got the coronavirus food assistance program direct payments that have been announced yesterday, and they're going to be working off of the market losses that they estimated for the first and second quarter of this year, and it's $4.71 a hundredweight for the milk production in the first quarter, and then potentially another $1.49 in the second quarter with the adjustments. And that won't be immediate, but I know they're going to work hard to get the 80% of that out to begin with. And then what USDA is going to do is make 80% of the payment for all the different commodities, and then step back, reassess how they're doing budget-wise, and they may have to do a little rationing on the remaining 20%. But if they get that out coming up here, then hopefully that is some cash flow assistance for dairy farmers.
Thank you, Chris. And that acronym is a mouthful, the coronavirus package, but it's significant news on the dairy front. So let's go to another poll question here before we turn it over to our banking team here. Our poll question that Jim Baltz will put on the screen: what actions are you taking during this economic downturn? And you can answer more than one. Implementing cost control measures, reevaluating lines of credit, readjusting amortization schedules, requesting a deferral in principal payments, or you're making no financial changes. So go ahead, audience, take that poll question. And as we're taking the poll question, I want to remind everyone that we will be taking questions from our audience. And as you hear Chris, Sam, and Roger talk, please put those questions into your area there that you can type them in, and my coworkers Caitlin and Maggie will sort through those. So we're going to cut the polls off here in about 5 seconds here and see what the answers are from our audience. So here we go. Here, implementing cost control measures is the #1 response. Reevaluating lines of credit is second highest, and then no financial changes comes in third. So with that, let's turn it over and welcome Sam Miller to DairyLivestream. Sam's been working in the dairy banking sector for over 3 decades. He originally started out with M&I Bank and now leads all of agricultural lending at BMO Harris. An articulate thought leader, Sam is also a faculty instructor for the National School of Experienced Ag Lenders. Sam, you have deep dairy roots. What would you like to share with dairy farmers and their agri-service partners when it comes to finances during this pandemic?
All right, thanks, Corey, and welcome to everyone on the live stream today. Appreciate the opportunity to be with you. As Corey mentioned, I work with BMO Harris Bank. I'm part of our food, consumer, and agribusiness group. We cover the entire food chain within that group. And my group works with farmers and those they buy from and sell to. So kind of the suppliers to and buyers from farmers is the piece that I have in that. I just thought we should level set, where we are. 2019 ended. We've had a tough dairy economy for a little while. 2019 ended actually in a pretty good spot. We saw improved financial performance from our dairy clients. Same thing with suppliers and processors in that space. So as 2020 began, there was a lot of optimism. Milk prices were above average. Futures prices were good. Exports were looking good. USMCA, U.S. Canada Mexico trade agreement was signed by all 3 parties. China Phase 1 deal was done in the middle of January. And worldwide dairy production and demand were in balance. So things were good. And then bang, a pandemic hits, and talk about a dairy farm finance pivot. The entire world had to pivot. So stay at home became the new way of doing business. So what did bankers do? Here's some observations in no particular order. We started looking at our portfolio, and we looked first at what was the cost of production on a client by client basis. What price risk management plans did our clients have in place? Dairy margin coverage, DMC, dairy revenue protection, DRP. Maybe they had contracts or futures and option positions. We looked at where their milk was being shipped and what that particular processor was doing. Were there any quotas they were putting into place? Were there cutbacks? What kind of dumping milk was going on? And we looked at their working capital position. What kind of cash, working capital, and borrowing capacity did they have to withstand whatever and for however we were going to have more difficult milk pricing environment. And then it's hard to believe 6 weeks ago, the government in the first CARES Act, or probably version 2 or 3, implemented the Payment Protection Program, the PPP loan program. And we had a lot of clients take advantage of that. The majority of our farm clients and many of our suppliers accessed those loans. And that certainly helped them to defray some costs for payroll and some other expenses. So now we're having individual conversations because the low milk prices are really starting to show up in the mailbox. And so it's about what is the cash flow timing of the income coming in. You know, the milk check is below cost of production, but how soon will you achieve either government payments that Chris was talking about, dairy margin coverage payments, dairy revenue protection payments? Those are going to be off into the future. So what kind of cash and working capital are people doing? And like your poll question, cost control measures. Our clients have been really working hard at how they can control costs. That's been some of the side benefits of the current environment is feed costs are lower, fuel costs are lower. You know, I've never seen some of the fuel prices that had been booked in by a bunch of our clients. So that was great. And then on an individual basis, we're looking at what other servicing measures, and that may be increasing lines of credit. It may be re-amortizing debt. It may be some principal deferral for a period until those cash flow timing matches up. So that's what we're seeing dairy farmers do. They've been working hard at trying to figure out where their liquidity is and what their borrowing capacity is. And most importantly, a lot of communication between banker and borrower and with all the other suppliers and vendors. So I think with that, Corey, I'll turn it back to you, and I think we'll get into more questions later.
Excellent, Sam. Excellent. Before we introduce our next guest, I want to remind people we have questions coming in and some darn good questions here. So go ahead and type those in, and we will get sorting through those. And we are very delighted to have Roger Murray with Farm Credit East. Roger is Executive Vice President with the organization, and he's based out of Connecticut. When we invited Roger to DairyLivestream last week, he was literally catching his breath. That's because the Farm Credit East team was working overtime for weeks in an attempt to help all farmer clients with COVID-19 related grants and loan applications. Now that the water's calm for a few days, what can you tell us about that journey, Roger?
Well, thanks, Corey. I'm really excited to be part of today's program. Really want to help discuss how farmers and related agribusiness can weather this pandemic storm. First, a little bit about myself. I grew up on a dairy farm in northern New York. It's currently being operated by our third and fourth generations of our family. I grew up competing in 4-H dairy cattle judging contests and always completed the Hordes Dairyman. I was actually very fortunate this last year to get 100 on the Holstein class. I just want that to be well known. I rarely ever do that well. I won't tell you what my total score was, but I'll share the one that I can. After college, I started working with Farm Credit, and I've been here ever since in various roles, providing loans, financial services over those 38 years. And through that time, there's been a lot of variability in the dairy industry and cycles. Certainly the going back to the whole herd buyout program back in the 80s, for those on the call that can remember that. But we've been providing financial services here in the Northeast, our 7-state area, which includes New York, New Jersey, and parts of New England. We provide over $7 billion in loan volume to 14,000 customers, and about 25% of that volume is to our dairy industry. So with that, we have a large financial service program doing tax returns, record keeping, payroll. So as you can imagine, as was discussed with the PPP program, we've been very busy supporting customers to get information in and submitted, whether it's through our process or others. So we've also been very busy, as was mentioned with Chris, on our crop growers, crop insurance agents are out there working on DRP and other risk management services. So a lot of things are going on, and that's been a good thing to support our customers. But I would tell you, over my career, one of the things that I'm very amazed at and very proud to be part of the industry is the resiliency our dairy producers have shown over these years. So they cut costs, they innovate, while all being competitive on the local, national, and global front. So 2020, we don't expect any different. We think those folks act quickly, limit their losses. There will be good times to help them recover in the future. Most of our producers, as Sam mentioned, are in a good position. They're coming off a healthy 2019, so they can absorb a few of the losses. But as has been discussed, the variables are many. So our keys that we've been talking to customers on to success is utilizing a team approach. Trusted advisors, whether that's your veterinary, your nutritionist, or your loan officer, and others. Developing Plan A, Plan B, Plan C, and utilizing all those tools available, as was discussed, whether they're the USDA's Coronavirus Food Assistance Program, PPP loans, et cetera. So Chris and Sam have already talked about a lot of the items from a lending standpoint and what the market's doing. I guess I wanted to talk a little bit on the human side. Is one of the things that we're really promoting is increasing the level of communication, not only between our staff and our customers, but certainly the customers within their business. They need to work with their team to develop budgets, compare to industry benchmarks like our Dairy Farm Summary or Cornell's version and others, depending on where you're located. Lay out those options, but make sure you evaluate where you're at every 30 days. Make sure you're including whoever pays the bills on your farm in those discussions. Remember, those are the folks that are feeling the brunt of this. They're deciding who to pay and who not to. And while many of the farms have been out planning and getting ready to start first cutting in the next week or two, those folks need to also pay attention to those that are staying inside and paying the bills. My advice, or our advice we've been given to young partners, is step up. This is when you can offer to be more supportive of the business and be helpful. If you're an older partner, know when to ask for help. Provide an opportunity for some of those other younger partners to gain some of your wisdom. And lastly, make sure you're taking care of your health, both physically and mentally. Here in the Northeast, we're fortunate to have the New York FarmNet, which also, and here at Farm Credit East, we have a customer assistance program that's available on our websites, completely confidential. So I'm opening it up with there. I'm really looking forward to the questions, and hopefully we can provide some advice for folks that are interested. Thank you.
Well, excellent. The questions have been coming in really quick here, so we'll start right out here. Roger and Sam, how are you looking at credit worthiness in this new environment? What's new? What's still a bedrock?
If you don't mind, Roger, I'll start. I think,
go for it, Sam.
You know, the fundamentals of this business have not changed. You know, bankers look at the 5 C's of credit, right? Character, capacity, collateral, capital, and conditions. And none of that has changed. It may be the priority we're looking at it. I mean, and right now, the first line of defense is working capital. What's that working capital look like? And liquidity, and figuring out maybe a burn rate. How long can you survive with the capital that you have in the short run to be able to withstand some adversity? I think second, we're looking at price risk management. What kind of protection versus open situation do you have to figure out where you're at? And then beyond that, it goes to what type of equity. Because we've had a couple of tough years before 2019, like 4 of them, a lot of those measures have already been pulled. You've moved debt down the balance sheet, from short-term debt to longer-term debt. So in a lot of cases, there's not a lot of that room left to do. I think those are the keys that we're looking at. Roger?
Thanks, Sam. I would say what's new is nothing. In that we're approaching this downturn like we've approached all the others. The interesting tweaks will be, though, is some of the assistance programs that others have talked about. So I think that's a key. The other is depending on where you are in the U.S., the certainty of your marketing channel is probably more of a consideration now than maybe it was in the more recent past. Back in the early 1900s and 1940s, there was a lot of change with what's going on in the dairy industry and a lot of consolidation. And lately, there hasn't been too much change in that. We've seen some markets, though, really firm up and not have a lot of choices for customers to ship their milk to. So I do think what is really strong is that we believe, as Sam mentioned, talking about liquidity is the real key right now to get through how quick you're able to adapt and innovate to this market disruption, and these price cycles will be a big thing to be considering. So with that, I'll turn it back.
Early we started the program with Chris here, and we were talking about, futures are pushing $16 for that May to December average. And if you pull May out of there, they're a lot better than that. There are some people that wish they could have signed up for Dairy Margin Coverage Program. There was a plea to USDA Secretary Perdue to reopen that program. They didn't do it. But there are some options here. They may not be perfect options here, but from a banking perspective, or Chris from an economist perspective, there are some options here to put a floor. It may not make you profitable, but it may make you salvageable. I don't know if that's a good word, but maybe talk about what you might be able to do with these current futures or DRPC and live to fight another day, maybe being 2021 being the year that we recover here. What do you got for thoughts on that?
Well, I think there are certainly a number of options, and we've had our clients taking advantage of several of them. Direct contracts with suppliers, and whoever your processor is, that's one option that's out there. We have a lot of people that are aggressively looking at the dairy revenue protection, the DRP. Those prices aren't going to be out today or tomorrow because of USDA reports, but Friday again, we got a lot of people that are interested in seeing what the prices are and whether they start taking some protection in Q3, Q4, Q1, and Q2 of next year. Options have, that's size neutral. You can buy an option. It doesn't matter what size of business you are. And that's certainly a way to, if you buy a put option, to have a floor on milk and still leave the top side open. And those are all tools that our clients are taking a look at, and we're encouraging them to investigate it and figure out where they can go.
Yeah, I'd echo what Sam just mentioned. A lot of our customers have done very similar to that. If you're looking forward, now would be a good opportunity to take and evaluate where your cost of production is. It's so variable based on that. But where's your cost of production, and how does that fit for some of the third and fourth quarter prices that we're seeing out there in the market? We're evaluating that as part of our total risk evaluation of the farm, how they fit, where their market is, and due to us here in the Northeast, several of our markets have developed a base excess program. So we're trying to work through customers that are working through budgets on how that's going to impact them, and working through other over the market tools as like DRP and others to help them weather this, especially and provide a floor for a minimal price in the fall.
So I think obviously Sam and Roger have made some really good points. I think if you know where your farm financial status is as far as, especially right now, liquidity and solvency, that doesn't tell you what you should do, but it can help indicate if you need to do something, right? You know, Sam talked about burn rate and where you run up against some of those break points as far as liquidity and solvency in particular. And the closer you get to having a solvency or liquidity problem, the more important it is that you be paying attention to these risk management opportunities, because you can't afford to, you know, go below a certain benchmark. And so I'm probably not going to surprise you to hear farm business management economists and some bankers talk about how you need to be tracking this stuff. But I think, you know, if you know your cost of production, like what Roger was talking about, and you make a plan that makes sense for you, then you look for the opportunities and you take some of the emotion out of it. You know, you communicate to the team like Roger was talking about, and everybody's on board with this is what we're going to do and how it's going to work. And then, you know, a lot of times in these markets, there are opportunities, you know, that you can take advantage of. And I think right now, certainly there's potential there.
I've learned in some of my business dealings that in these times, bold actions can make you come through this and look pretty good in years to come. But you got to be smart with your bold actions. And specifically to that, how are customers adapting and being innovative? Do you have any examples in that realm?
Certainly, a number of our customers are working with a lot of folks on their team to come up with ways to, if they have an 18-month supply of feed, maybe this is the year they cut back and only grow enough to fill the bunk back up, not necessarily provide a 6-month excess. They're evaluating how many young stock do they need to continue to raise. We've been a lot of our customers have internal growth rates, herd growth rates that are extremely strong, and right now may not be the best time to be raising all those young stock. So there's a lot of new ways. I will tell you the other part with our customers is that we're so close to other markets. And that's a positive when it comes through times like this. There may be opportunities for other markets for the farm to be entered into, whether that's growing some sweet corn to sell, the farm stands, those kind of things that can really help cover some additional costs and or utilize some excess labor. So it's been rewarding to see how they've gone at it. I would also say some of the larger or even the just more innovative farms have gotten into other markets, whether it's GMO-free, the A2 movement, all sorts of things that I think have allowed some folks to get a little bit of premium in the market that they might not have otherwise.
I'd add, I think, you know, Roger's on to a lot of points. Some of the simpler things have been, if you've got lower feed costs and, like I mentioned, fuel before, getting that locked in and really focusing on the cost control aspect. But there's been, in the last several years, the migration through genomic testing, and sex semen. We've seen operations start up their own, you know, beef programs, or certainly ways to try to right size the replacements with what the herd needs. I think those are some innovative aspects that we've seen as well.
Chris, I'm going to turn the next question over to you. And as our Dairy Livestream viewers know, that we also have Hordes Dairyman Intel, and after each episode, we have Caitlin and Maggie, my coworkers here, write up some of the items, and one of them will be about a paper that Mark Stevenson, Andy Novakovic, and Chris Wolf worked on late into the night and early in the morning. It's titled USDA's New Direct Payments Program for Dairy Farmers. We have a question that came in from California. In the paper, you talk about an example of an 800 cow herd here that would come close to bumping the payment cap of 250,000 under average production. But this question is specifically, how will general partnerships be treated under the CFAP program? For example, could 4 partners get $1 million, or how might that look? Have you thought about that, Chris?
Well, good question, Corey. The language in the bill has an individual payment limit of $250,000, but then explicitly says that for LLCs, S corps, mostly L corporations, and for limited partnerships, that up to 3 people that are member owners of that can collect the payment of $250,000 for an overall cap of $750,000. But the people that are involved have to be making substantial contribution to that farm business, which they define as 400 hours a year, which is probably not very difficult for these guys to meet. And then you have to keep in mind that there are some other rules about adjusted gross income of 900,000, and that there's the potential that you might be collecting on more than one commodity. For example, there's a 33.5-cent payment per bushel of corn that, or the lower of what you marketed in 2019, half of what you marketed in 2019, or what you had in storage on January 15th of 2020, which is interesting to me to define it that way. So, you might have dairy farms that have corn and soybeans. Maybe there's apples or something else, depending on where you're located. And so all of that has to come into consideration. But if you're, an LLC, which, a lot of the dairy farms are today, or some other form of organization like that, there are ways to be beyond the 250 and up to 750.
So Roger and Sam, we're going to turn this one over to you. What % of your dairy loan accounts do require specific risk management plan for 2020? So they're asking for a %, but certainly risk management is a thing that everyone should be looking at. But as a loan officer, how do you approach that for your team?
I can jump on that first, Sam. Here in the Northeast, I would tell you overall crop insurance and risk management has not been as widely utilized as in other parts of the country. And so from that standpoint, we've been an underserved area for a number of years when it comes to crop insurance and those risk management tools. So along those lines, I would also say a lot of our customers have not been as aggressive at utilizing them. So we would look at other things in addition to whether or not we require a revenue policy or some other risk management tool for milk prices. Certainly requiring liquidity, being held at certain levels, and other real estate and or other resources to try and shore up the collateral position on some of these.
Yeah, so requirement is the key word there, and we're not in the practice of generally requiring crop insurance or some of the price risk management tools we've been talking about, but it may make the difference between whether you get access to funding or don't get access to funding. So it's all about, we ask our clients individually, what's your plan? And then we have to make a credit decision based on that plan. If we can't get to a yes on that, we'll share with them why. And the why may be because there's too much price risk. So what are your plans beyond that? And that's how we handle it on an account by account basis.
Chris, this is a real specific question here. And the question is, if producers locked in a base at $11, so we were talking about a couple weeks ago or a month ago in the market, can they cancel that contract or base without a penalty? So I got to read in a little bit to that, but that's the way the question came in.
So were they talking about locking in a base on like using a futures contract, do you think?
Let's go with that, because we got to have some kind of foundation.
Well, I mean, if you sold a futures contract at that price, then you can either leave it and it will cash settle, or you could buy one back. It kind of depends on your time horizon and whether you think there's some opportunity that it could turn the other way. If you buy one back now and remove that position, then you've locked in that loss. On the other hand, you're probably getting some pretty significant margin calls if you're in that position right now. So it kind of depends on a lot of different factors. But you know, if it was a co-op forward contract, then you'd have to be talking to them. But
it's not an easy one. That one's almost a one-on-one consultation. Let's move on to another question here. And we posed this one to Andy Novakovic way back in one of our earlier programs. But I do think, given what came from USDA yesterday, we should talk about this. Do cull cows or bull calves, or if you're in a beef enterprise, and all dairy farmers are, do they qualify for the CFAP payments? And I think the short answer is you have to document some revenue from them, but would the panelists like to talk about that?
Chris, you probably know that better than Roger or I do.
Well, I think if you can document it, like Corey said, then you can probably qualify. But it might depend on kind of how big you are and whether you're bumping up against limits already. Whether it's worth that.
Little I've read, I'd say the same thing. You know, I think that program, it's going to be stacking in the various enterprises that where you actually have sales.
This is an interesting question here. Maybe we should end with it, but we'll go with it now. And I think people are looking for just something they can take away that's like, I'm going to get off DairyLivestream and I'm going to do it right away. So that's, I think, the mindset of this question. But what's one piece of perhaps surprising advice you'd give farms right now to take action? Why don't you all think about that one?
Yeah, I got to think about that.
We're going to come back to that one. Here we're going to have a very specific question, and I think it's Chris, but maybe Roger is actually good at this one too. And I'm going to read it just as it came in, so you get the spirit of the question. What are the pitfalls of taking an EIDL loan? I already received $10,000, but it looks like signing up for more could cause problems down the road for borrowing money from regular bankers. And you guys have worked with some of those EIDL loans. And if you want to share that acronym, I couldn't go through it quick.
I'm by no means an expert. We've been working a lot on the PPP program, and now we're just pivoting to support a lot of our customers as they evaluate the EIDL program. I do believe it can provide an opportunity for some folks to get a loan for a longer term should their working capital be needed. So it's really more of a working capital loan. And right now, for some folks that are extremely stretched when it comes to liquidity, that might be a good alternative. And whether or not there's $10,000 forgiven or not is not the key. It's more the term that they might be able to put together for that loan.
So it's Emergency Income Disaster Loan. That's what EIDL stands for. And it's also run through the SBA. It's a direct loan from the Small Business Administration versus the Payment Protection Program loans, which were run through financial institutions and guaranteed by the SBA. And Roger's right. You could get up to $10,000 forgiven. That's $1,000 per employee. You can't get both the EIDL $10,000 and the Payment Protection Program loan program. So when we had clients look at it, most of them went through the PPP program. It was more advantageous than doing the EIDL program. And we've had a few that have looked at it for a future loan. but I don't know. It's been a little while since I've talked to my relationship managers, but I don't think we've had many that have actually applied and are looking at it. What are some of the drawbacks? If you have a limitation against other debt with your bank, that's another loan. So you got to be communicating with your lender about it, because it could have some implications. And like Roger, I haven't delved deep enough into the program to see if there are some other limitations. Pledging of collateral, of some other, the repayment. I know it's a long-term repayment at a low interest rate, but so far I don't think we've seen a lot of adoption for that program.
Well, we're glad to bring DairyLivestream here today on May 20th. It's sponsored by Diamond V, and we appreciate their sponsorship. And as I predicted to Caitlin and Maggie, my coworkers here, the questions continue to come in fast and furious. But we're also receiving comments from some people here. And Andy Novakovic writes in that there will be no payments for cull cows and bob calves, but the dairy beef would qualify. What is dairy beef? That would be steers. And so appreciate that clarification, Andy, and that you're typing that in. And let's go to another question here. To what extent do you have producers who are investing in their long-term future during this pandemic? Specifically, are there producers that are modernizing or expanding? What about this whole issue of production base? I think that's a little bit a foreign concept here in the upper Midwest where I'm broadcasting from, but the Northeast, the West, the Southwest has been dealing with that a little bit. Sam, Roger, what are you seeing?
So I think that particularly, like I mentioned before, we've had a tighter a dairy margin environment for the last half a decade, and so investments in efficiency have been going on. Whether it's parlor efficiency, already talked some about genomics and breeding efficiencies in regards to equipment, cropping equipment. A lot of efficiencies have been employed there as well. Automation, labor has been tighter in the last few years, and so we've had people looking at maybe automating and moving to robotics as an alternative. So I think those plans have continued. As far as larger scale expansion, that's been more limited. And you hit on a very good point, and Roger talked about it as well, and that's, do I have a market? A few years ago, we never really asked people much about that. We asked, okay, where are you shipping your milk? And that was the end of the conversation. If somebody wants to expand right now, we're having the conversations about, okay, can you actually sell that milk? Do you have a supply agreement? And those are critical conversations. If you're gonna try to grow your way out of some challenges, you better make sure you got a market for where that product's going to go.
I would add that any expansions we've seen, we've also required a letter from their market saying that they are behind the expansion and will continue to buy the milk from the increased facilities. So that's been a sure thing for us to make sure that customers don't get themselves in a bind. As far as investing in for the long term, a lot of folks are investing in training of their key employees. So I think that's a real positive. You don't always think of your employees being one of your assets, but they can be some of your key ones. And then obviously, as Sam mentioned too, certainly things that help reduce cost per hundredweight and or positioning themselves for new markets. Maybe it's the parlor upgrade, et cetera. Hauling your own milk is something that is more and more farms have looked to do if they have the equipment and folks with the necessary licenses. Also, a fair amount of folks concentrating on protocols to improve their milk quality. Maybe they're one tier away from the best, and if they can get everybody on the same page and getting that quality just a little bit better, that might qualify them for a little bit of additional premium. So that's some of the areas that we're seeing.
Thank you. Certainly the new reality here, and I'm not sure I really like some of that term, but everybody's doing a little schooling from home here, and we got Chris's daughter that's going through a little bit of work there behind him, and got a chuckle out of him. But Chris, in your paper that we're also going to push out on Hordes Dairyman Intel tomorrow, you detailed how dumped milk is being accounted for, and it needs to go through there's some rules for that when it comes to the CFAP payments. What about dumped milk?
Well, it's got to go through the federal order, and but the federal order administrators have made accommodations that made it easier to report and get that accounted for, which is a good thing, because in some parts of the country we've seen a real increase in the last couple months of dumped milk. Also, what I'm hearing, and maybe Sam and Roger can chime in on this, I'm hearing less of it. One thing that's impressive about the dairy supply chain is kind of how resilient it is at kind of figuring things out. And this is hopefully a once in a century occurrence, and there was some dumped milk, and we're awful good at producing milk, but the co-ops and processors are also good at finding a home, which they've been working hard at.
Yeah, I think we've seen that across our, like Corey, a lot of our clients are in Wisconsin, and there's a tremendous variance in processors and where people ship their milk. And so some had some pretty stark plans as to how much they wanted to see reduced and put people on a quota type of system. And others were, hey, I'll take anything you got. And they've all cut back on how much is being dumped. And because Chris, you talked earlier about how milk prices have been rising because of a couple of new demand sources as states open up, and the food service channel, which that pipeline had been empty, starts to get filled up a bit. There's more demand for those dairy products, and so that's why we're seeing that. And I think the big question mark, interestingly, one of the processors wrote saying, "Hey, we're reducing this quota for the month of May, the quota that you can't ship us, but we're going to reserve the right to increase it in future months, depending upon where things look in June, July, etc."
We got a question that came in here, and we're got about 10 minutes left in the program here. And the question is, what's your thoughts on team meetings with managers, loan officers, veterinarians, nutritionists, and accountants? And I will take the first stab at that one. Communication is now more important than ever. And yes, yes, and yes. Talk to everybody. Get communication flowing, because you get good and bright people together, you can solve a lot of problems and create even opportunities. Roger, Sam, or Chris, anything to add there?
Yeah, I'd add that, and then also, like anything, now's not the time for a mistake. There's no oops and very few do-overs. So now's the time to make sure things are well thought out, you have a plan, and you've reached out for all the available resources that you can possibly use to make sure it's going to be successful.
I think, you're absolutely right. And all of us have hit on the importance of communication, and it's ultra important now. That doesn't mean it has to be all face-to-face. I think that what we're doing right now, we're all communicating, and there are plenty of tools out there that you can use. Or the old simple way, which is the way that I've been doing most of my business the last 60 days, just good old conference calls. It's much better if you can see people, but you can still get a lot of information and communication across via conference call.
I'm always, I got to read this question the way it is, because I think they're inaccurate here, so I don't want to reinforce what's inaccurate. But the way I read CFAP, if you had a milk hedge, you could not apply. Does DRP fit under that umbrella? I don't believe that hedging applies to this at all. I want to be clear, but I'm going to wait to hear from the authority.
Correct. It doesn't apply to this at all. There was some confusion that there was not clear whether maybe it was an FAQ that was put out that was a little early and was incorrect, but there was some some feeling that there was a wording in there that said that it was for milk that was not under price risk, and interpretation that that would mean that they weren't going to pay if it was covered by dairy RP, and that's not correct. That if that was ever in there, it was removed. That doesn't. There's no like penalty in the sense of using dairy RP here.
Yeah, or any other risk
Any other one.
strategies. I'm going to ask this question, and I'm going to give a preview to next week's show, because I think that's really for next week. What effect might additional government support do to herd size? Do you think farms will stay the same, grow, or divide? I'll leave that one open if anyone wants to comment, but next week's show we'll have the CEO of the International Dairy Foods Association, Michael Dykes, and the CEO of National Milk Producers Federation, Jim Mulhern. I think that's a little bit more of a policy question, but I will open it up to say, what do you see the trends in dairy farms? I mean, you got some that are growing, there's some that are serving niche markets, but what's the future look like if you're going to be in the dairy business 10, 20 years from now?
I obviously would echo what others I'm sure are going to say as well, and what's been commented already. I think the trend for higher quality is going to continue, as well as extremely niche marketable products, as I mentioned some of those, as well as being a low-cost producer. I think anymore the world markets are such we got to be able to compete on a global level as well. So that can be small farms, it can be medium-sized, it can be large, but we've seen a decline in the number of farms in the U.S. Over the last 100 years. We'll continue to see that. So as people specialize and consolidate, that will happen as well.
I think Roger's spot on. I mean, there's been a trend. Excuse me about that. There's been a trend of consolidation of dairy farms. There's also been a trend of increasing milk production per cow. So, you know, that's been a component of that. Fortunately, there's also been a trend of increased consumption. Let's hope that continues, given the shock that the system has had in the last 90 days. As to, and Roger's right, pick your lane. You know, you can be the most efficient, you can serve a local market, you can have a specialty product, whether that's organic or A2 or, you know, grass-based, and that's where that market's headed. And we've gone in this country to being export driven. That's the marginal dollars, I think, for milk prices. That change has happened in the last 20 years. You know, we moved from being essentially a domestic market to 1 day's milk getting exported. So what happens in other countries and what happens with currency rates and trade agreements and you name it, has a big impact on what our dairy industry is going to look like.
Well, we're going to go to rapid fire here. We got about 3 to 5 minutes left here in our May 20th Dairy live stream episode, sponsored by Diamond V here. And rapid fire, one person answers each question, but this is probably to Roger or Sam. How do you evaluate collateral versus cash flow when making loans?
It starts with cash flow, and you look at collateral second. I mean, if we're not going to make an asset-based loan generally, okay? So it starts with cash flow. That's where the first point of emphasis is.
Chris, why have we seen such large price swings in the last 2 weeks?
I think the reopening in some states, the anticipation of eating out, and then the kind of the supply adjustment that's been made in some regions, or has been, you know, there's been incentive for supply adjustment in some regions. Let me put it that way.
We have a viewer that asked this question here, and we got it at the 11:59 minute mark of last week's show, and we wrote an elaborate response to that dairyman in California. And if this viewer that asked the question sent an email to our live stream, we'll send them our elaborate response. But a couple of producers have been disappointed in their DRP payments. And part of it, I think, is this yield adjustment factor. DRP was, and I'm helping to answer this question, but DRP was modeled after crop insurance. And there's obviously a lot of yield variation in crops from county to county, but you don't see that in milk. So I think one of those factors that dairy farmers are frustrated with that yield adjustment factor, and they're getting dinged on that a little bit in their eyes. Does anybody want to comment on that one? Otherwise, I'd ask the audience member to send us an email, and we're gonna publish that response as well.
So, did you want to go ahead, Roger?
No, go ahead, Chris. I was just going to say this to handle that one off, but go ahead.
Okay, well, I was just going to make one comment, which is that so the yield adjustment factor is based on a trend increase in milk per cow, and you would have a payment adjusted downward if that increase in milk per cow was above trend. Well, if we have herd consolidation and what's happening is that low producing cows are leaving, and there's relatively more high producing cows, then the average milk production per cow is going up. And if that's happening at a quicker pace than the trend, then that would result in a negative adjustment, so that the times of stress and increased consolidation could, at least in theory, move that off of the trend and result in a penalty there, which I don't think was necessarily the intention. And usually we're talking about something that should be pretty minor.
Chris, could the Class 3 price increase we've seen in the last 2 to 4 weeks cause a large negative PPD, producer price differential?
Yes.
That's the short answer, not an answer you want to hear if you're cashing a milk check.
But it does mean that, but it does mean the next month will be a lot better, right? So, if the negative PPD is because of that big increase in Class 3 or 4, then it's coming, right? So,
interesting question that just came in 2 minutes ago. Have any of your customers had positive COVID-19 cases in their staff or when their families? Do you know what strategies they put in place to handle the situation?
I've not heard of any. That doesn't mean that we haven't, but it hasn't risen to the point where it's a big question mark or concern. And I think people have been pretty smart about, talking and communicating with their staffs, making sure that there's plenty of space in the break rooms, and are trying to have social distancing as much as they can, particularly in the parlor. Have a shift turnover so that you're not having people congregate between two shifts at the same point in time. So that's how I'd answer it.
You're being based in one of the hotbeds of Connecticut and New York. We've certainly seen and heard of some impacts for some of our operations. Fortunately, nothing catastrophic yet. And I'll echo Sam's comments. Everybody's doing the appropriate measures that have been laid out on social distancing, masks, and quarantining folks that are turning up positive and or have symptoms. So it's requiring innovative ways to manage labor. There's no question about it.
Certainly, I'm not a pandemic specialist, but if you look at and read a lot of the materials here, some of this COVID-19 is a density issue, a population density issue. And, some people have thought that this may change the trend, that millennials have been moving to inner cities, to new population centers, and people may be thinking that. And a lot of rural areas outside of meatpacking plants have been spared from COVID-19 cases. We're going to wrap up this program, Dairy Livestream, sponsored by Diamond V, with one more question. What would be the final words, Roger and Sam, that you would share about helping farmers survive this crisis and living to be for a brighter day?
I'll jump in and let Sam be the final. I think remain positive, have an outlook that we'll live to fight another day. And I think that's one of the key pieces that you can do to support your team. The other part, since we're getting close to Memorial Day, is make sure you take time to remember those that gave their lives for us to enjoy all our liberties, and then certainly those that you may know that have had someone pass recently. It's been extremely difficult on them as well. But I really think our dairy industry is well positioned to come out of this stronger, and we're really going to be supporting them every way we can.
Well said, Roger. Thank you. I'd have kind of two, Corey, one qualitative, one quantitative. On the qualitative side, it's keep your relationships, reach out to family, friends, your vendors, keep those communication channels open. And on the quantitative side, have a dashboard of metrics, production and financial, that you're monitoring so that you can stay on top of your business and right it. Get back in the lane if you're getting out of tolerances.
Well, thank you. This episode was again sponsored by Diamond V. Our conversation will continue next Wednesday, May 27th at 11 a.m. Central Daylight Time. On behalf of Roger Murray, Sam Miller, Chris Wolf, our production manager, Jim Baltz, and my coworkers, Maggie Gillis and Caitlin Allen, this is Corey Geiger signing off to this week's Dairy Livestream. Thank you for joining us. Have a good day.
Thank you.